You're about to hear my conversation with David Ross, Managing Director and Global Head of Private Credit with Northleaf Capital Partners. Today, David will introduce us to the private credit asset class. We'll talk about the growth of the asset class post the financial crisis and why it's secular, as well as where Northleaf does and does not deploy capital. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, Head of Portfolio Construction. Today, David Ross, Managing Director and Global Head of Private Credit with Northleaf Capital Partners, is joining us. David, what a treat for us. Thanks for joining the podcast today.
Great to be here. Thanks for having me again.
Now, David, you are in the private credit markets every day and have been for many years, but many of our listeners may not actually be familiar with private credit. At a high level, how would you describe the private credit asset class?
Yeah, and private credit is at its simplest lending to companies. It can take all different forms. I've been in the ecosystem now since 2003, and it certainly has evolved over that period of time. But people should think about it as lending to businesses with, call it 100 to $1.5 billion of EBITDA. That's the space that we play. And really, when we're doing it, we're looking at how companies perform, what position they have in the market, and certainly analyzing the financials and management team.
Very good. Now, David, the private credit space, again, at the asset class level, this is an asset class that has become increasingly important since the financial crisis. Could you help our listeners understand why that has been the case and perhaps take some time to go through some of the regulatory changes that occurred during the financial crisis that has led this to the reality that we have today?
Yeah, sure. I mean, there's naturally over the course of the past 20, 25 years, there's been a fair amount of change in the ecosystem. I guess there's probably three trends that are probably worth articulating. The first is just the growth of the demand. So the vast majority of what we're doing is lending to private equity backed companies. And so private equity has grown significantly over the course of the past 20 plus years. And so there's been a continual demand for private credit in order to help finance the acquisition of businesses. To your point around the regulatory capital change, that's probably the second trend that happened in the global financial crisis. So when I first started, the market was divided between banks that did the senior loans and institutional investors like us that did the junior or mezzanine loans. And so what happened in the global financial crisis was the regulators decided that banks shouldn't be holding huge stores of assets on their balance sheet. The way I affectionately refer to it is the regulator decided that they should be in the moving business and not in the storage business. So historically, they used to effectively make the loans and then hold them on their balance sheets. Regulation came in, it restricted the amount that they could hold and the terms that they could hold them on. And what that created was a market opportunity for institutional investors. And at the time, that was predominantly pension plans, insurance companies, sovereign funds to really fill that void. So you had third party capital providers go out and raise capital from institutional investors and start providing the senior loans that historically had been provided by the banks. And so that was the key regulatory change 2008, 2009. And then I'd say the final trend that's probably relevant is just over the last 10 or 15 years, what you've seen is private equity firms continue to grow up market. And so scale in terms of the size of the company they're lending to. And private capital actually increasingly start to compete with traditional forms of public capital. So high yield and broadly syndicated loans were typically for the largest businesses. As some institutional investors have scaled, they've started to provide that source of capital as well. So really three key trends: general growth from private equity, obviously the regulatory change that brought in the institutional capital, and then finally, as that institutional capital scaled, it actually got to the point where it became a meaningful supplement or competitor even to broadly syndicated loans and high yield.
David, I want to ask you a follow up question based upon what you just shared, because I think our listeners would find it quite interesting. If I think about a lot of Canadian investors, the perception is it's the banks that get to make all the loans to the highest quality companies, and private credit firms are often lending to whoever is left. But the reality is, especially in Europe, the United States, if not in other parts of the world, it's the other way around. It's the private credit companies that are often lending to the most creditworthy borrowers, and the banks might be competing for other deals. What's your perspective or insights on that view?
Yeah, and you're right. Some markets are very different. So if you were in Japan or in the Nordics, even, or to some extent Canada, frankly, those are still pretty bank driven markets. You have large banks with significant balance sheets. You correctly pointed out that the US and Europe has changed dramatically in that respect over the course of the past 20 years. And so back to the question as to where the capital is coming from, you have had this pretty dramatic shift between banks being the primary source of capital for these borrowers to institutional investors. And I'd say there's two key drivers of that. The first we covered already, which is regulatory change, which the balance sheet of banks in Europe and North America just shrunk dramatically and were replaced by larger pools of capital from institutional investors. The second piece, which I think is an important trend, is when you think of the global financial crisis, that was really a banking crisis. It metastasized into a bunch of other things, but it was triggered by liquidity issues and challenges from banks. And so, what I think a lot of borrowers realized were banks weren't necessarily that stable, consistent source of capital that they'd grown to expect. And so, they readily engaged with what I'll call longer term, more natural holders of their loans, which were these institutions that were effectively raising capital from insurance companies and pension plans. And so there's been a number of different factors that have driven it. But certainly, I would say that today's market in the United States and Europe, banks are an increasingly small percentage, and they've really been replaced. The majority of the capital is coming now from institutional providers.
So interesting, and really a great way to introduce many of our listeners to what I would argue is the secular story and the opportunity for private credit going forward. I want to build on something you mentioned earlier. You made reference to private equity sponsors. My understanding is that many private equity sponsors look forward to working with a partner such as Northleaf because of deal size, because of the size of the loan that you would be able to offer versus banks now needing to putting together large syndicates, and coordinating amongst 10 banks can be very difficult. Is it also true that that's been part of the opportunity for private credit right now and going forward, just the size of the loans that can be provided?
I think there's a couple things. So you're right. We've spoken now about the fact that the available capital. When I first started, I moved to Europe in 2005, and there were some Nordic banks that would easily write $500 million loans to single companies. Post the global financial crisis, that would have gone down to 25 or $50 million or euro or Nordic currency equivalent. And so, you really had this massive contraction of available capital. Whereas the institutions, as you say, can write larger single checks and are more consistent, stable sources for that. The second thing is that I think people realize that banks provided reasonably fixed forms that, I think private equity firms felt they needed to fit into. And when you brought in institutional capital backed by pension plans, insurance companies, and increasingly alternative distributed forms of limited partners, you end up having the flexibility because you've got larger teams that can look at an individual business, understand what that company's capital needs are, and tailor the loan and the capital to what the private equity firm is looking to do. And I think that's been an important change because almost by its nature, private equity is catalytic capital. It's looking to buy something and then transform that business through acquisition, through various forms of rollout strategies, or sometimes through a cost out play. That requires a degree of flexibility, a solution in terms of the capital, and not just a fixed loan on fixed terms. And so I think both the scale and also the solution oriented nature of institutional capital are probably the two key drivers that account for the growth over the past couple of years.
Very good, David. I'm glad you made reference to institutional capital because it allows me to move forward now with my next question. Institutional investors have been allocating to the private credit space for quite some time now, and they continue through 2026. Why do institutional investors continue to allocate here when they have other opportunities, including leverage loans or the high yield debt market?
It's a good question. You're right to say that there has been a pretty stable and consistent growth for a lot of institutional capital. We have some that have up to 20% of their book in private debt. Many would be in that 3 to 10% range. So it does form a consistent and a reasonably significant portion of a institution's investment strategy. I guess there's a couple components that we've noticed from our investors over the course of the past couple decades, really, as they've grown out these portfolios. The first is when you think about what they are looking for, the key thing they are trying to identify is stable sources where they can keep a reasonably consistent allocation and where they can outperform other asset classes. And if you look at private credit for the last 20 years, it has outperformed liquid alternatives, whether that's a broadly syndicated loan or leverage or the high yield market. And so when you're picking up 1 or 2% incremental return, that is something that's very attractive. But really, the critical thing for them has been the risk equation. What they have seen as they've witnessed the asset class over the last 20 years is you're getting that incremental return with lower volatility and lower risk. And by risk, I mean the credit statistics that you can apply to that loan and the loss rate that has been experienced over the last 20 years. So, really attractive relative value trade for them where they can pick up incremental return for lower risk. There's obviously a trade off in terms of liquidity. And so, their longer term perspectives is that they'll have a balance. And actually, I would say the vast majority of the investors we have will have some leverage loans, they'll have some high yield, but the majority of their fixed income have moved into private credit because of that relative value trade in terms of risk relative to the amount of spread that they can generate for what they see as an attractive underlying loan.
Very good. David, as far as an argument goes, the fact that performance is superior and risk and vol are lower, I don't know with regards to investments if there's a better argument to be made. So thank you for that insight. Now, with regards to the approach at Northleaf from a private credit perspective, before I go into where you do invest, I'm kind of curious, are there areas, whether it be industry or geography, that you don't invest?
Yeah, it's funny. That's where a lot of investors actually start is what don't you do? So it's probably a good place for us to pick up. From our standpoint, there's two main areas that we typically avoid. The first is we avoid consumer discretionary loans and avoid cyclical businesses. So good examples would be storefront retailer restaurants, travel leisure. Those are things we won't do just based on some of the volatility of consumer demand. The second thing is something like commodity driven energy businesses, again, where you get volatility in the underlying performance. Fundamentally, we're looking for stable, consistent cash generative businesses. And so things that have more volatility, we tend to avoid. The second thing is unpredictability. We do like risks that we can quantify and that we can price. And so for us, things where there's a regulatory risk, some sort of legislation, we tend to avoid those issues where there's a stroke of pen risk that's hard to quantify. Again, when you're a lender, we look to get our principal back and collect our coupons. And so anything that goes against that fundamental principle, whether it's volatility or unpredictable events, are typically things that we're avoiding in creating our portfolios.
Very good. I have a good understanding of where you don't invest. So, where do you invest?
I'd start by just saying diversification. Again, when you're a credit investor, it's very different than equity. Diversification is a critical mitigant to risk. And so when we build portfolios, we're generally looking to size individual positions appropriately to the mandate. We're typically looking for 1 or 2% position sizes. And so for us, diversification is critical. But what that extends naturally to is geography, it extends to industry, and it extends to the underlying risk that's driving the individual loans that we're making. So we invest across North America or Europe. Typically, that'll be about a 70-30 mix. We like having the two largest private equity markets as ecosystems that we can originate in. But to take an example, Europe was about 18% 2 years ago. We've tilted that now to a little over 30%. And so we'll seek diversification, but tilt very actively based on where we see the most attractive risk return opportunities. And then industry for us, we have a portfolio strategy analytics team, which really ensures that we keep discipline around our industry allocations. They set specific parameters, we have target allocations, and then based on macro factors, as well as what we're seeing in the market in terms of the opportunity set, will allow slight over and under allocations by the industry in order to ensure, again, we're being disciplined about driving underlying diversification within the funds.
Phenomenal. David, you've helped us understand how you get access to opportunities in partnership with private equity sponsors. You've just really laid out quite well how we should think about this from a portfolio perspective, the management of risk. I am curious. Obviously, this is at 30, if not 50,000 feet. When you're looking at specific credits, you live and breathe credits every single day. What are you looking for and what really represents a good credit from your perspective?
First of all, I would say that our job, I always describe it as it's like a Rubik's Cube. You've got multiple sides, and in each side, you've got multiple dimensions. And so, when you're doing credit, you're always trying to optimize different risks that you can mitigate or diligence, or situations where you need to price or structure appropriately. For me, the three most important factors, number one, are the underlying cash flow of the business. Lots go into that: revenue stability, industry growth, competitive dynamics. But ultimately, what we are looking at is a business that has generated stable, consistent cash flow over a long period of time. And that whether it's through the contracts or the products or services that they are selling, we can have confidence in terms of the future stability of that cash flow. And so we quantify that and we diligence that very, very consistently. The second thing is our loan document, which is different. That's not the company we're investing in, but this is very different than equity, where we have a 250-page loan agreement, and the terms that we agree to help ensure that we can protect the downside. And so I look quite a lot about the leverage we put in place, the structure, the legal terms. Those are critical to mitigating the downside for us as a lender. And then the final thing I'd say when I look at businesses, again, making sure that we're building diversification, is alignment. We want to make sure that the owners of business, the management of the business, the employees within that business are aligned to the outcome. Because when things go wrong in a business, we can be very constructive, but we need to ensure that we've got the right team managing the company that have the right alignment of incentives to ensure that if the business is going through a period that is more unstable or unpredictable, we can be supportive and they can guide it through that period. And that is the critical piece of lending, always making sure that you have the right management team with the right alignment to support the company.
Excellent. I have one more question for you, David. The time always races by when we have you on the podcast. Just want to get your current view as you look forward. We're in an environment versus 5 years ago, higher interest rates, wider spreads, makes for sensational headlines. But, when I speak to private credit investors, a lot of them actually speak to this is kind of a better environment. It's a real opportunity to find opportunities that will pay out for investors over the next number of years. As you look at the marketplace right now, how would you describe the environment and how do you feel about it as an investor?
Yeah, it's a good question. I mean, so obviously 5 years ago, we were coming out of COVID. The market environment was very much what I would describe as a risk on. People were very aggressive in that market. Interest rates were still low. This was pre the period of heightened inflation. This is pre the some of the geopolitical issues. So it was a very competitive market, and people were very aggressive in terms of type of terms. I step back today and I look at the last 5 years, having been through COVID, having been through inflation, having been through both Ukraine and now the Middle East in terms of geopolitical challenges. I think the market is very much in terms of a heightened sense of assessing risk and appropriately pricing it. So for me as a credit investor, what that means is that I can structure loans more appropriately. I can price them at a slightly higher level, and I can feel that I'm generating better relative value for my investors. And the market does go through cycles. I think about it as an accordion. There's some markets where you want to be allocating a little bit less because you feel like the risk is not being properly reflected in the structure and the terms. And there's certain times where you want to allocate a little bit more. And we're certainly in that period where I feel like our investors are benefiting from investing more given what I see in terms of how I can price and structure loans. And I think that is to do with the fact that people are doing a better job of assessing the multitude of risks that are out there and structuring them appropriately in the loans that are being made.
David, this has been such a great conversation. I wish it could go on for much longer, but we are at time. Real great opportunity and treat for us. Thank you again, David, for joining us on the podcast, and I look forward to having you back sometime soon.
Great. Thanks a lot for having me.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.